Hello everybody, Jackson here with the Wealth Squad. Today we'll be talking about how to find stocks to invest in. Right now we are looking at a couple criteria already chosen. We have the country USA. I put that either USA or Canada is fine with me. I usually don't try to go any further than that just because it is getting into the country territory. And if I don't know about the policies of that country, like China for example, could control a lot more of the companies than maybe America or Canada can. So that's why I try to choose just the more, what I would say, well-known and well-versed countries, especially for U.S. investors. And then PEG is the PE ratio over the growth rate. That basically says under 1 is a good deal, over 1 is not, but 1 is the average deal, basically saying that the earnings and the growth rate are about the same, and that's average. And then the forward PE is just next year's earnings. That's price over EPS. So essentially, if the company is earning a lot of money, a lot of income, the EPS will be high, thus making the PE ratio lower. And in that case, we would like to invest in that company because a more profitable company is better than a less profitable company, and that's just from the very beginning of investing time. You don't want to choose a company that doesn't make much money because, how are they going to improve their business? How are they going to pay off their debt if they don't make income? So just based on that, we could start our search here. The problem is there is no way we could just look at -1 industry, right? So if I could take out energy, I would, because energy is a cyclical business right now. It's doing wonders. Right now, you'd be loving it if you are in energy stocks like ExxonMobil, Chevron, ConocoPhillips, Pioneer Natural Resources, Schlumberger, Occidental Petroleum. But that's not what we're looking into. We're looking into companies that have a good brand, that have been, it's been improving over time. Sales been going up, profits going up. So besides that, we could see Bank of America. That's also a tough one, just because banks are on the way out, in my opinion. But you may see a different opinion. But so does Warren Buffett, right? So I'm sure he knows more than me here. Blackstone. We have Caterpillar, Charter Communications, Micron. We have Target, and here's where it's like an obvious one because Target has been slammed lately. You can see from 250 to 150 in this just 3-month chart span. Amazon, it says here, this is wrong, but it says a 3 PE ratio and a 65 billion market cap. That's just because the split went through today, and Finviz has not yet brought that back to reality, where the PE ratio, since it has to do with price, and now the price is a 20th of what it was, you just gotta times that by 20 and you'll be get right back to it. Same with the market cap. Schlumberger, Oil, Occidental, FedEx. We have Ford. That's a tougher one. KLA Corp, MetLife, American International Group. So a lot of these are well known, but we get into like the more brand consumer friendly companies here. HPQ, they do computers, we know that. Dell, also computers. We have Discover, you Discover credit cards, that's an easy one. T. Rowe Price, they manage assets for wealthy people. Ross Stores, an easy one. DR Horton, not so much. I was thinking of something else. United Rentals, we see those stores all around. And just out of these, you should pick companies that you know. VF Corp, you don't know, but they own a lot of brands that you do know. Hewlett Packard Enterprise, just a different part of HPQ. CarMax, we've heard their commercials. Ally Financial, we've seen that commercial. Companies like this, Darden Restaurants, you've gone to Red Lobster before. Olive Garden, that's the owner is Darden Restaurants. it's important to invest in a company that you know, because if you're driving down the road and you see a store coming up and it's a company that you now know, right? It's CarMax, it's a CarMax store, or it's a Ally Financial ad you hear online or you see online. You could be like, hey, that's my company. Let's see how good they're doing. You can check the ad, make sure it looks good. Um, I was a big investor in Starbucks for a while, and I love just driving down the street and seeing new Starbucks stores. I love to see the people inside those stores and in the drive-through and be like, all right, good, I'm still making money just because that company is still doing well. So I think it's important to invest in companies you know before you actually invest in them, and as well as it has to be a good financial decision. You want to do you could change these around a little bit. Under 2 is somewhat acceptable. Under 30 is somewhat acceptable, but besides that, that's as far as you should go. Um, in that case, that's about it. If you guys have any questions or comments in the just put those in the comments section, and I'd love to see what you think. But generally, this is how you should go about things. Of course, you get even more specific with the growth rate, the EPS growth rate, the sales, return on equity, dividend ratio, quick ratio, profit margin. That just gets into the individual business because each business is different, right? Energy and consumer car sales is a completely different business. They will have different profit margins as well as growth and generally different financials. So it's hard to decipher between one company in a completely different sector than another, and that's why you can't really do much specific stuff. But generally, put something like this at least, go through, see what companies you know, and then you gotta make sure they don't have too much debt. They got a nice cash balance. The management has been in there for a little bit and they know what they're doing. The companies are all over the place. But yeah, that's the basis of stock picking, is just finding companies that you could rely on and sticking with them. So I hope you enjoyed today's video. Thank you for watching, and until next time.